Hi, I'm Joshua Kirkpatrick, and welcome to Penn State Behrend's series on financial literacy. Today, we'll be talking about interest and interest rates. First, let's start with the facts. If you have a credit card, chances are you'll have more than one interest rate. Additionally, the higher your credit score, the lower your interest rate could be. And believe it or not, although this may be difficult to do, you can even negotiate your interest rate. Now let's look at the basics of an interest rate. Simply, an interest rate is referring to the amount that a lender charges for the use of the assets. And in most cases, that's cash. It's expressed as a percentage of the principal amount or the initial amount of money that you borrowed. Now, it's usually noted on an annual basis, and it's important to note that this is often referred to as the annual percentage rate, or APR, but we'll touch on that later. Now, let's denote a very important relationship between risk and interest rates. The higher your risk, the higher your interest rate will most likely be, and vice versa. However, let's look at some interest rate terminology first. If you'd like, I will give you a second to pause the video to ensure that you really soak in all of the information. Let's start with principal. The principal amount is the initial amount of money that is lent or borrowed, depending on which side you're on. Accrued interest is simply the amount of interest that has built up over time since you started borrowing the money. Delinquency is simply the failure to repay your outstanding debts in the appropriate amount of time. Time period, it's pretty self-explanatory. It's the amount of time that you're borrowing the money for. The rate. The rate is the percentage amount to which the interest will be calculated on the principal amount. And lastly, the compounding period. That's the length of time between the last time interest was calculated and the next time that interest will be calculated. Now let's talk about how interest works. It's important to note that different types of interest utilize different calculations. However, let's take a look at the most basic form of interest. Simply, interest to be paid out is equal to the principal amount multiplied by the interest rate multiplied by the number of periods. But be careful, whenever performing this calculation, you have to make sure that the interest rate and the number of periods are in alike terms. For example, if you had an annual interest rate and you had a number of periods in, say, months, then you would have to convert the number of periods to years so that years and the annual interest rate will be alike. Now, let's look at an example problem. What will I pay? If I took out a loan to purchase a car, and the terms are as follows, the principal being $10,000, the annual interest rate being 5%, and the number of periods being 5 years, what is the total amount of interest that I will pay? If you'd like, take a second and pause the video. So what is the total amount of interest that I will pay? Well, the answer is B, $2,500. It's important to note that I asked the total amount of interest rather than interest just for 1 year. But let's look at where interest and interest rates are commonly found. Almost every big financial decision involves interest and interest rates. So the short answer is practically everywhere. For example, if you want to buy a house, you would most likely need to take out a mortgage, which in turn would involve interest and interest rates. Unless you're able to afford to pay for something outright, more than likely you'll be dealing with these. Now let's move to the portion of our presentation where we talk about the types of interest and interest rates. Let's start with fixed versus variable interest rates. Starting with fixed interest, it's relatively self-explanatory. The interest rate is fixed. It remains the same over time. You can use these fixed interest rates to avoid having your mortgage or loan payments change over time. And borrowers are more likely to opt for fixed interest rates during periods of low interest rates, meaning if you can secure a low interest rate, it will stay the same even whenever interest rates rise up. But it should be noted that these can be higher than variable rates. However, on the other hand, let's look at variable interest rates. These are fluctuating rates that are based off of an underlying benchmark or index. And the basis depends on the type of loan or security. But for the most part, they're usually based off of the prime rate, which we'll touch on later in this presentation. These kinds of rates can be commonly found in mortgages, credit cards, bonds, and etc. But the one thing to take away is that if the underlying rates rise, then the interest payments will also rise. Now let's turn to the annual percentage rate. Simply, this refers to the annual rate of interest being charged to borrowers and paid out to investors. Expressed as a percentage, it represents actual yearly costs of funds over a term of a loan or income earned on an investment. And it is important to remember that financial institutions must disclose this prior to signing any sort of agreement or contract. And at the bottom, if you take a look at the top portion of the calculation where it says fees plus interest, you'll know that this doesn't just simply include interest, but this includes all of the costs. Recall I said the costs of funds. Funds not only come with interest, but also fees for the most part. So this really captures all of the fees as well as the interest that you'll be paying within the annual percentage rate. Now let's turn to introductory rates, also known as teaser rates. Now take a second and think back. Have you ever heard could be as low as 0%? Well, if you have, then more than likely you've heard of an introductory rate. Essentially, introductory rates are the interest rate that is charged to a customer during the beginning period of a loan or any sort of borrowing. Basically, it's meant to market to consumers, to bring people in so that they think that they're getting a good deal, but it's not always the case. So just like APR, it's important to remember that introductory rates must be disclosed prior to the signing of any sort of agreement or financial contract. Now let's talk about the prime rate, something that I mentioned before. The prime rate is the most widely used benchmark for home equity loans and credit cards. Prime essentially means the best rate being lent to customers with good credit. The most current prime rate is 3.25%. Now remember, I said that the variable rate was based off of the prime rate. That does not mean that the variable interest rate is the exact same as the prime rate, but rather the prime rate plus a spread or margin is equal to the variable rate. So variable interest rates are directly related to the prime rate. However, the prime rate doesn't exactly lend itself. Now let's talk about simple versus compounding interest. Simple interest is extremely easy. Essentially, the payment pays interest first, and then the remainder goes to the principal amount, and it can be commonly seen in auto loans and short-term loans. It benefits consumers who pay on time or pay early, and typically uses a fixed interest rate. However, compound interest, on the other hand, is interest that accumulates per period, and unless it's fully paid off, it's added back onto the principal amount, so that whenever interest is calculated again, it calculates not only off of the principal amount, but the accumulated interest as well. For deposits, interest is reinvested. However, For loans, unpaid interest is simply added on top. And now, the compounding effects really depend on two things: the applied rate and the frequency of compounding periods. Now let's talk about amortized interest, simply referred to as the amount of principal and interest paid each month over the course of a loan's term. Dealing with payback loans, at the beginning of a loan, most of your payment will go towards interest. Later on down the road, each payment will be focusing more and more on the principal amount rather than interest. So whenever you compare amortized interest to simple interest remains the same for each payment over the course of a loan's term. However, amortized interest goes from dealing mainly with interest to slowly decreasing to only dealing with principal and just a tiny bit of interest at the end. Now let's talk about how interest rates can affect you. It's important to remember a lower interest rate doesn't make a debt go away, said by Dave Ramsey. I highly recommend you check out any of his videos or his radio talk show if possible. Now let's look at some average interest rates found across the United States. It's important to know the average interest rate for each of these activities, such as an auto loan or a mortgage. It's important to know them because whenever you go out searching for an auto loan or say a mortgage, then you'll know if you're getting a good deal on the interest rate or not. You don't want to pay more in interest than you have to because you're already paying for a loan. But let's talk about some factors affecting your interest rates. In every case, you'll find that every individual will more than likely receive a different interest rate, depending on some of these factors, such as employment history, credit history, or even the credit score. If one of these factors, in your case, isn't stellar, then chances are your interest rate will be higher as a result. Now, it can be difficult to know if an interest rate is right for you. However, following these few steps, you'll be able to better understand why your interest rates are higher or lower and how to really tell if you're getting a good deal. First, for a prospective opportunity, determine what the term and rate is. Next, shop around. Look for better rates somewhere else. If you're working with a bank to start, maybe look at other banks. Maybe look at financial institutions. However, then take all of the rates that you found during your shopping around period and compare them. Then, following that, calculate out what you'll be paying in interest on a monthly, semi-annual, and annual basis. And whenever you have all of these figures for each of the opportunities, then you should ask yourself, will this significantly harm my financial standing? If the answer is yes, you should very well decline all of the opportunities. However, if you find that it won't significantly harm your financial standing, then you should move forward with the best rate and accept. Now let's look at some common interest mistakes. One mistake, two mistakes, they can add up. If possible, you should look to avoid any and all of these mistakes I'm about to talk about. First, if you can buy a used car rather than a new car, you'll be saving on not only the principal of the payments, but also the interest rate of the payments. As well, not investing. You should invest as early and often as possible. Because of compound interest, you can see that your investments can grow to a substantial size over time. As well, paying too little. Whenever dealing with interest payments or principal payments, payments in general on loans or things of that nature, you should look to pay as much as possible without harming your financial standing. This is because interest won't go away, nor will the principal. So if you pay down as much of the principal as possible, you'll find that your interest payments will go down, and it will be a lot easier to pay off the entirety of the loan over time. As well, spending too much on a credit card. You should only be spending as much as you have. And in that case, you still shouldn't be putting your financial standing in harm's way just to spend some money. As well, you should try and avoid missing any sort of payment. Whenever you miss a payment, it comes back in the form of fees or an increased interest rate. Essentially, it will only harm you to miss a single payment. Lastly, lacking information. Whenever you go into any sort of financial situation, you should be extremely aware of the information that is going into the deal, the information regarding your own financial standing, and what type of deal you're being involved with. Now let's take control of the system. Don't let interest rates control your lives. So here's some tips and tricks to take control. First, negotiate your rates if possible. This is difficult to do, but if you're successful, you can find that your interest rate could be dropped over an entire percentage point. Next, spend only when necessary. There's no sense in spending money frivolously. On top, invest, invest, invest. Make sure that whether it's retirement investing, your life savings, or even just an emergency fund, make sure you're investing that money and it's going into smart places rather than just being spent or collecting dust. Next, keep watch. Make sure that you're aware of when you have to pay your bills, how much the interest on your bills are, and lastly, make sure you're aware of the assigned rate. Next, refinance your debt. After making arrangements as far as, say, a mortgage, for example, after paying down the principal amount over a few years, without missing any sort of payments, always paying on time and paying the correct amount, you can go back to the bank and refinance your debt in order to get a lower rate. This in turn will make your monthly or semi-annual, annual payments even lower than they were before. And lastly, don't overpay. Make sure that whenever you're offered a deal involving a certain interest rate, make sure you go shop around. Look for the best deal possible. And, whenever able to, go for the lowest rate. Now let's look at the impact of different interest rates. Let's look at two loan scenarios with a principal amount of $10,000 and a term length of 1 year. Now let's say in scenario number 1, the interest rate is only 5%. However, the interest rate in scenario 2 is 10%. Over the loan term period, or 1 year, you'll come to find that in the first scenario, you'll be paying $500 less in interest simply because you made smart decisions, you went out, and you found an alternative to the second scenario, and you made the right choice. Now, let's look at why interest rates differ from one activity to the next. Let's compare an auto loan versus a mortgage. Mortgages typically have lower interest rates. Why? Well, that's because mortgages have a lower default premium, meaning less people fail to pay their mortgages every year than, say, an auto loan. A house acts as collateral, or the asset behind the loan. So if the loan is defaulted on, then simply the bank can come and repossess the house and get much more value out of it than a car. And lastly, mortgage terms are almost always longer than a car loan, which in turn provides less risk for the bank or lending institution. Now let's look at one specific case. Don't be fooled by payday loans. Payday loans are short, unsecured loans, typically with high interest rates. Whenever you drive down the highway, you might see a big flashing sign that say, "Cash advance, get cash now." But don't be fooled by those flashy signs, because what they're trying to do is take advantage of your money. Typically how it works is lenders are approached by consumers who say, "I need cash now prior to my payday." Then the consumers write a post-dated check, giving it to the lender, dated for the day that they are paid. Then the lenders offer the consumers a lump sum of money, which is much less than their paycheck. The consumers, taking the check, then work until the day where they're paid. Whenever they're paid, rather than the money going straight into their bank account and staying there, the check is deposited by the lenders, taking the money away from the consumers. Essentially, in the end, what happens is consumers are taken advantage of by the lenders, receiving much less money than what they would have made from their paycheck, just because the consumers needed the money a few days ahead. What's the issue here? Payday loans can increase the likelihood of bankruptcy, worsen household cash flows, and indebt the borrower because of the high interest rates that come along with them. Now, this concludes our presentation on interest and interest rates. Thank you for watching and have a pleasant day.